Well, folks, we have a lot to get into on the reaction channel here today. There's three videos I want to react to. Consumer spending jumped in July as retail sales were up 1%. I want to react to this breaking news out here a couple hours ago. Walmart earnings this morning, and then I want to react to this one. Next jobs report will be a needle mover. But here at the top of the video, we're going to go through a bunch of stocks. We're going to talk about what's going on out there in the market, where some opportunities are, where some opportunities, unfortunately, are going bye-bye. Yes, there's some stocks that are moving so huge that they're starting to move into not as big of opportunities now, and that's a little disappointing. So a lot to get into in this video. Appreciate y'all joining me. Thank you for being subscribed here to the channel. We're on the road to 50,000 subscribers on this channel. We're getting pretty close, so appreciate y'all being here. Pin comment down there today if you're looking to apply to join my private stock group, my private wealth group, take your game up to a much higher level than where you're at. I'll put that as a pin comment. You can click on that, fill out an application. We'll see if we can get you in there and access to that. So good day out there overall. Honest is big moving again. The stock's now up over 200% in the past year. 10% move here today. Some of these small caps are, it's interesting because the Russell hasn't really run yet, right? It's having a good day today. And you got to understand these stocks like Revolve, Honest, right? Revolve's up 8% here today. If the Russell really gets rolling big, the Tom Lee type move, I mean, my gosh, some of these stocks are going to be 2x, 3x the price quick. And when I say quick, I mean like within months. And it's pretty extraordinary because you look at Honest, there's no news in regards to Honest, but yet it's up 10%. But look at the Russell. The Russell's up about 2.6%. So you have Honest, a company that already has momentum. The fundamentals are all coming around, right? And all of a sudden you get a decent day in the Russell and thing takes off like a rocket ship. Same thing with Revolve. Revolve's fundamentals are all starting to get better now, right? And so you have a lot of these small caps where the stories are changing in regards to them. You got the fundamentals coming around. Simultaneously, you have a belief that the Fed's about to start cutting rates, which a lot of people look at is going to bode very well for small cap stocks. And it's completely changing the game in regards to small cap stocks, right? Another good example is the Planet. The Planet stock, that stock has climbed like something like, I was looking yesterday, I think it was at a 72% gain in the past 5 days. Like, it's absolutely incredible move for the Planet. So, and that's another perfect example of the fundamentals of the company are all getting better. Simultaneously, you have all of a sudden some level of excitement starting in the Russell, but keep in mind, the Russell hasn't made its move yet, right? I mean, the Russell, if we pull up a 5-year on this baby, I mean, we haven't even gotten close to all-time highs in the Russell, right? All-time highs in the Russell's way back here, November 2021 at 2,400. So we're not even at all-time highs on the Russell. We're still 300 points off of all-time highs. Meanwhile, the NASDAQ's, very close to all-time highs, right? It hit this technically all-time high right here in mid-July. But if you look at the previous all-time high, we are around 16,000. We're 17,500, so 1,500 above. I mean, that's quite significant. The S&P 500 is right around all-time highs. That previous high back here, before the recent highs, right, was around 4,700, and here we are at 5,500. So the Russell is the one index that has lagged big. If the Russell was trading where, let's call it, the NASDAQ would be trading, the S&P 500, you would see the Russell right now at probably, I would say, 2,700 to 2,900, which when we're talking Russell 2,700 to 2,900, you got to understand this is so significant for so many of these small cap stocks, and the moves these stocks will make is going to be ridiculous if we get that sort of situation, right? But the problem with the Russell over time, it's done a lot of fake outs, right? Where you think, oh, the Russell's running, and then it always lets us down. But the one thing I will say about this recent run in the Russell is it looks a little more real, right? Like where we keep climbing, we pulled back, we keep climbing here. So, but back here, it's kind of like up, down, up, down, up, down. And it's like, are we ever going to have a real Russell roll? So we'll see. Obviously, Tom Lee, we know his call on the Russell is very, very bullish. So if that happens, it's going to be a lot of fun here. Now, Elf's starting to come back a little bit to life. That stock, obviously a tremendous performer over time, but it's lost a lot of its gains recently. This stock got all the way up to about 220. It's down to 154 today. Tesla coming back to life a little bit. If the market wants to go risk on, Tesla's going to do well. That's just the bottom line in regards to that. Estee Lauder is doing very well here today. Cheesecake's doing very well. It's another small cap stock, 5% move. If we talk about the Russell goes to 2,700, 2,800, whereas Cake, $60, $50, something like that. I mean, it's up a lot. SoFi is another perfect example of one of those risk-on small cap stocks. Shopify, what an incredible move for Shopify. Check this out. I mean, from those Monday lows, that was just, the incredible sell-off we had on that Monday, right? And look at this baby now. Almost 45% just from where it was last Monday. That was 9 trading days ago? Insane how fast some stocks can move. And remember, people, they hope to make 44% over a 3 or 4 year span in the S&P 500. And Shopify is giving you that 9 trading days. That's why when you get those rare opportunities of everybody's freaking out, panicking, the VIX spiking huge, you have to take advantage of those opportunities because those are very few and far between. Very few and far between. Amazon's making a nice move here today. Nike's making a nice move. I don't want Nike to go up. I do not want this baby to go up. This is another perfect example of getting it at those Monday lows, 13% already. But this is one, I want this to stay down. So Bill Ackman, he started a position in Nike, right? Pretty significant one. Yeah, I don't want Nike to go up. I want a stock like Nike to stay down in the short term because that's one I want to continue to buy. I want a stock like Wynn Resorts to stay down in the short term because that's another one I want to continue to buy and load up on shares. You may say, well, what about recession with Wynn? Don't you fear recession with a stock like Wynn? Not at all. Bring it on. Like this is one of those stocks I feel comfortable buying in any sort of environment. Recession, high interest rates, low interest rates, right? Ideally, the best situation for Wynn is low interest rates, good, strong economy, right? But let's be quite frank, if you're at low interest rates and you got a strong economy and you got a strong China, right? Wynn's going to be 200 plus in that sort of environment. So I have to take advantage when it's in the 70s and things aren't seen as good and China is seen as weak and we're seen as high interest rates and everybody's worried about the economy and what's going to happen, all these sorts of things, right? So that's what I look at for a stock like Wynn, but this is one I absolutely love. NVIDIA, they love to pile into NVIDIA. Meta as well. But it's interesting, some of these big tech stocks are the laggers today, right? Meta's actually kind of lagging, 2% move. NVIDIA, 3.6% for NVIDIA is kind of lagging, honestly. PayPal, 2% move. So some of the bigger stocks are a little laggy today other than Tesla because Tesla's just so mega risk on, right? But then you have a lot of my small cap stocks doing tremendous. Honest at that move. You got Avant there with that big move. Revolve at that big move. Elf kind of gets put in the small cap category, even though the market cap's grown so much over the last couple of years that it's kind of getting out of the small cap category, but it's still kind of put into that, right? Cake's a small cap stock. SoFi gets put in the small cap category. And look at the way those ones are performing. Meanwhile, big tech's kind of like, it's okay. It's okay. Let's go ahead and pull up this watch list. So this was all stocks that were down 20% plus, but now some of these stocks aren't down 20% plus anymore, right? If we go ahead and take a peek at Buc-ee's, look at Bucks. It's come back so strong, it's now only down 2%, so which means it has to get deleted from this watch list. Nike's, if this one keeps coming back, next thing you know, this will be out of the negative 20% stocks. Sam just got out of the negative 20% stocks here recently. So we'll keep that one on for now because if it loses gains from today, it'll go back to the 20%. So for now, we'll keep that on. Bath and Body Works is another one that's struggling big time, down 26% for this year. Estee Lauder, 33, almost 34%. That remains a good buy in the short term. Lululemon, very disappointing price action in regards to Lululemon. I think if you're looking at Lulu stock, you should be worried. Very worried. So what I heard Lululemon beat estimates, and I heard a lot of people were pretty excited about that at first, right? But here we are with this stock, right? A 6% move? When you think about how much Lululemon's down, this stock's down almost 50% this year, right? It's basically been cut in half. And keep in mind, the S&P 500's done good this year, the Nasdaq's done good this year. And Lululemon's at 6% gain on the day that's supposed to be seen as a relief rally on this positive of day in the market. Listen, that's not good. This would be seen as kind of taking an L in regards to Lululemon. The fact that it's only up 6% on a stock that's been cut in half and should have a great relief rally. This is a stock that ideally you would want to see up 20-25% today. Given how much it's been destroyed and coming in with better earnings than feared, like this is a type of stock you'd expect like a 20% upward move. 6% on a day like today? No bueno. No bueno. Speaking about no bueno, Celsius has obviously been no bueno, right? No good. But this stock's down about 28% this year. It's actually really attractive here recently, especially under $40 a share. We'll see what happens, though. The Nielsen data hasn't been the best. It also hasn't been the worst for Celsius, but I listened to that conference call 3 times. I listened to Celsius conference call 3 times, folks. 3 times. Now, the problem with that Celsius conference call was the management team. This management team at Celsius is usually one to kind of beat their chest. They're usually one to be very optimistic and just kind of make almost everything kind of sound good. And I walked away from that conference call feeling like, I don't know if they're that confident. And so I think a lot of other big investors and funds and whatnot kind of walked away from that call as well. And remember, a lot of these folks are kind of more shorter term in nature. They're a little more, focused on the day-to-day in regards to the stock. And so they're not going to like something like that. They want to feel confident about it right now. And so, I don't know, man. Like Celsius looks very attractive. It looks very attractive, but I just thought the management team didn't do the best job of conveying that conviction that you'd want to see in that situation. Ulta is another stock that's been hit heavily this year. Even after today's 12% upward move, the stock's still down 24%. So this is on the back of Berkshire Hathaway building a big position in Ulta. The big Buffett, Mr. Warren Buffett himself, Warren Buffett buying Ulta stock big here recently. So we don't know if it's honestly Buffett. It could be Todd or Ted at Berkshire making that buy. I mean, it's a really good business model. It's, a lot of people thought this is a Todd and Ted move. It could be Buffett. It could be Warren Buffett was actually the one that decided to pull the trigger here on Ulta. And let me lay out the case that it could be him. We know Buffett loves simple business models. Doesn't get much simpler than Ulta, right? You're selling makeup and cosmetics, and you're still selling in retail stores and their online platform as well. We know he loves very profitable companies, and we know he loves companies that cash flow heavy. That would be Ulta. Ulta is very profitable. They produce a lot of cash flows. We know Buffett loves proven management teams. I think the Ulta management team could be seen as a proven management team at that company, right? And we know he loves companies that he could see as kind of having a somewhat of a moat around it. And I think to compete with Ulta is very difficult because of their store count, their online presence, and their brand name. And so it's difficult to try to compete on that sort of level, right? It's going to cost so many billions of dollars. And then so many connections to make with all of the cosmetics companies is very, very difficult. So I could see him looking at that as somewhat of a moat around the business. So overall, it's a possibility. It could have been Buffett that made the move there. And we know he's bought plenty of retailers over the years, right? Yeah, we'll see. Now, in terms of safety stocks, Walmart's the best. We're going to react to Walmart's earnings here in just a moment. If we look at, but a lot of those stocks aren't doing that great considering how good of a day it is in the market. Chipotle. Yeah, good day for Chipotle today, which I'm not the happiest about, but that's okay. It is what it is. You can't win them all, right? I'm glad I took some profits, but now I'm like, maybe I should have taken all my profits in regards to this one. This is my possible buys watch list there. I don't like how much green. This is the thing, like, I love all the green for my current stocks, but I don't love it when my possible buys watch list is all green. Like, no. I don't love that. Uber, by the way. Uber, I heard Lyft's going after market share right now. Word on the street, Lyft's going after market share, and so they're undercutting Uber prices. That could bode bad for Uber over the next couple of quarters, so just a little food for thought in regards to that. AI stocks watch list here. Palantir is kind of weak today, which Palantir's been so red hot. It's been so red hot that it kind of needs a breather. I feel like today's one of those days, if the market was down, Palantir would probably be down 3-4%, just because I think I think there's a certain portion of people that are looking to take profits in Palantir. The stock's up 87% this year. Remember, people hope to make 87% over like a 7-year span in the S&P 500, over a 6-year span. So when you make 87% in 7 months, 8 months, right? 8 months. I mean, a lot of people look at that and they're like, this is an extraordinary opportunity because people hope to make 87% over 8 years and you make it at 8 months? Like, whew. So a lot of people just look to take profits. Banking watch list here. Everything's green, but not that green. I mean, some of these big banks like the JP Morgans, some folks are not looking at those as attractive because interest rates might be coming down. So some of these money center banks, people aren't liking them. Big tech watch list here today. Everything's green. Netflix is a big lagger, though. Look at that one. I mean, it's basically break even on the day. MU's biggest upward move. That's a memory chip giant there. If we look at commodities, commodities having a good day overall. A 1 year on commodities is up 1%. We'll take that any day of the week, baby. If we look at the Dow 30, it looks like Verizon's the worst stock of the bunch, followed by Procter & Gamble. I mean, those are kind of, some people like to flood to those sorts of stocks if they're, Merck, United Health. People like to flood to those sort of stocks if they're feeling risk off, if they're feeling concerned about the market. Today's not one of those days in the market, right? Today's one of those days in the market where everybody's feeling very good. They want to take risk. And so naturally, Verizon, Procter & Gamble, Merck, United Health, those sorts of stocks, Coca-Cola, they're not going to do very good in that sort of market, right? Those are sorts of stocks you need drama, you need volatility. Then people look to flood to those stocks. E-commerce watch list, Affirm's best move. I mean, that shows you what kind of day it is today, right? It's a risk-on day. People are all of a sudden feeling better about the economy. And next thing you know, stock like Affirm has a great day. Etsy has a great day. Very interesting. If we look at FinTech here today, so Rocket's down a bit, but that stock's been pretty good this year, if I recall. Yeah, 31% gain for this year for Rocket's pretty impressive. Everything else is having a good day on here. Hood's having a good day. Hood's had a very good year, 60% up. Some of that's on the back of, obviously, the market doing well, right? When I say the market, I'm talking the stock market. Crypto, they're making good money from crypto, so I think that's all kind of helping them out. Square's up about 3% today. PayPal's up about 2% here today, so we'll take that. Housing stocks watch list. FICO down. That's interesting, FICO down. That's one I've thought about hedging against. Interesting to see FICO down. My Mag 6 here today. By far and away, the best stocks are Tesla and Elf, both more risk-on stocks. Then followed by Amazon, Meta, PayPal, and then Palantir's a little teeny mover here today. Oil and gas stocks, all green, but not that green for those ones here today. And if we look at the travel watch list, very good here today. United Airlines up big, Hawaiian Airlines up big, CCL Cruise Lines up big, Delta up big, American Airlines up big. So a lot of, travel's another one of those spaces that people like to take a risk. They're going to go to the travel space. And also, if you have rates coming down, it's going to benefit a lot of these companies because pretty much all the travel companies, the airlines, the hotel operators, all these companies, cruise line operators, guess what? They have a lot of debt. Huge debt loads on those companies. And so higher interest rates weigh on the results of those companies. So it's much better if we can get interest rates down for those sorts of companies. And so if you're talking about interest rates coming down over this next year, 2 years, 3 years, whatever, however long the rate downward cycle lasts, right? A lot of people are going to see that as a positive for those stocks overall. So yeah, I definitely like the action out here today. I just, if I had it perfect, I would say my stocks all go up, but the stocks I want to buy all go down, right? All right, guys, let's react to some videos here.
Manufacturing for the month of August down 4.7%, and that follows down 6.6%. We have had a lot of negative numbers. Matter of fact, every number this year has been negative. Now let's look at retail sales. Headline number 1%, double plus expectations. 1%.
What was he saying was down here, though? What was he saying was down?
In the wires, Empire Manufacturing for the month of August down 4.7%.
Empire Manufacturing. Dang, that's a rough number, right? It's a rough number, but a lot of people look at that number and say, next year is going to be a better year, right? So, do you want to look at the glass half empty or half full? You can look at that number, Empire Manufacturing there, and say, ooh, bad, bad, bad. Stock should be down. Other people could look at that and say, hey, it's going to turn around next year. We're going to be fine.
And that follows down 6.6%. We have had a lot of negative numbers. Matter of fact, every number this year has been negative. Now let's look at retail sales. Headline number, 1%, double plus expectations, 1% on a headline number. That's the best going back to April of 22. April of 22. Let's strip out autos, Chef.
So a big important thing that I talked about going into this year is I talked about this interesting dynamic we could have that I don't think a lot of people were considering. And I said that as 2024 went along, we could be in a situation where the consumer gets stronger as the year goes on. And the reason being is 2022 and 2023 destroyed people for inflation, right? And obviously, inflation has tamed down in a massive, massive way as we're kind of rolling throughout the year. Now, jobs are still there. We know that, right? Wages are still there. And so if you have jobs still there and wages are still there, then you could be in a situation where essentially the consumer gets in a better spot as the year goes along and could get even in a better spot in 2025. If jobs remain there, wages remain there, right? And people aren't getting sliced and diced by inflation, then we talk about real wages going up. If you talk about real wages going up, you could eventually be looking at a situation where retail sales start to come back as we go throughout this year, right? And you could be in a situation where retail sales may become in better for the remainder of the year, maybe a better holiday season than a lot of people are anticipating, and the demise of the economy gets pushed out again, right? And then they're like, well, maybe next year it's the big job loss year. And so, and by the way, when people keep making these predictions about it's going to be, we're going to have the big recession, unemployment's going to spike high, like eventually people are going to be right. But it's like if year by year by year goes by, and it's like you're still waiting. And it's like, when's this 8% unemployment rate coming, this 10%, right? Like eventually somebody's going to be right? But as they say, a broken clock is right twice a day. And so that's just a little food for thought in regards to that. So, but yeah, I mean, it's a potential that the consumer could get stronger, and it's something that not enough people have taken into account, in my personal opinion. You got to take it in the market. You got to take in a range of possibilities. One of the best things I ever learned while I played poker, I was taking that serious for a while there, was you got to take in a range of possibilities when you're playing a game of poker, right? There's so many different things that can transpire, and you have to take it all into the possibility, right? Chess is another great game for learning like how to think in regards to there's so many different potentials that could happen here. There's so many different possibilities, so many different moves you could make, your opponent can make. You got to be thinking 2-3 moves ahead. And just a lot of people in the market, they get stuck in just one mindset, and they don't think like somebody would think playing chess or somebody would play poker, right? And it leads them to just like being a perma bull or a perma bear, and they're only thinking one outcome. And it's like, dude, there's a range of outcomes that could happen here. You have to take them all into account. You don't take them all into account, you're not playing this game on a very high level as an investor.
It diminishes, but still much better than the up 0.1% we're looking for. It comes in at up 0.4. Strip out autos and gas, still up 0.4. The control group, or what we call core retail sales, that is up 0.3. That's a pretty good number, 0.3, and it follows up 0.9. I don't see any revisions yet on the retail sales, but it may be forthcoming. Now let's look at Philly Fed. This is an August number, like Empire. Philly Fed comes in at -7. We're expecting a positive number, -7. Well, we were at -10.6 at the beginning of the year. That is your comp. Now let's look at initial claims. Initial claims, 227,000. That's definitely below the 235 we're looking for. A slight revision to 234,000 for last month. So that means we are down 7,000, and that is something to watch. It's probably why yields are moving up a bit. Because, of course, this demonstrates the economy might not be slowing as much, and the labor market actually might not be diminishing as much as the jobs report demonstrated. Now let's look at continuing claims. Are we going to have the 10th consecutive month over 1.8 million? Indeed we are. 1,864,000. And finally, a lot of prices coming in. These are July import prices, month over month, up 1/10. We're expecting a down number, up 1/10. That's the biggest positive month over month since April of last year. Strip out petroleum, and it is now up 2/10. Up 2/10 follows up 2/10. And if we look at year over year, those were month over month. Now let's go year over year to import prices, expecting up 1.5%, comes in a bit higher, up 1.6. That equals right now a revision. Last month's 1.6 now becomes up 1.5. But these are some of the juiciest numbers going back to the end of 22. Let's look at export prices month over month, expecting goose egg comes in higher at 0.7. 0.7 equals April of last year. To find a higher, you have to go back to August of 23. And finally, export prices year over year expected up 110. Buckle up. 1.4%. 1.4% is the hottest since January of last year. Now we see that yields pretty much up and equities up. Good news is good news. Some of these, of course, are showing the economy is doing better. Labor market not deteriorating as much, but it is a split decision. Claims on the initial side going down, continuing claims hanging tough. Santoli, back to you.
So I was just doing a little thinking about, how did so many people were predicting, obviously, like, the doomsday for the jobs market and all those sorts of things for the last several years, to be quite frank. I think there's two things that people didn't take into account when making that assumption. One was the Fed lags, right? I think a lot of people assume, like, as soon as the Fed goes up in interest rates, like, it devastates everything immediately. No, it slowly suffocates the economy, right? And if the Fed leaves rates too high for too long, we know eventually you end up in a major recession, right? And so I think that's one thing not enough people really took into account. Like, the Fed lags take a while. It's not like it's just, everybody thought, like, in 2022, like, that was just going to devastate everything. It's like, it doesn't really work like that. It's a process, right? The second thing I don't think people took into account was how strong the jobs market was going into this rate hike cycle. We've never seen the jobs market that hot. When I say the jobs market that hot, I'm talking specifically about the amount of job openings going in, right? The amount of job openings was all-time highs going into the rate hike cycle, right? I think there was just a ridiculous amount. It might have been 13 million job openings, some insane number, right? The amount of job openings going into the rate hike cycle in 22 was incredible, right? And I don't think enough people took that into account either, because even if certain industries lost jobs, people could pick up those jobs other places. The great financial crisis was a little different, because going into that, the jobs market sank very quickly. You weren't at nearly as high of a number. And then when people lost jobs, they stayed unemployed for 6 months, 12 months, 18 months. And that really weighed on the economy huge. This situation was not like that. It's like if somebody lost a job from a trucking company, went under, right? They could go find a job somewhere else, right? If somebody was a realtor and they weren't making their ends meet anymore because real estate market's been horrible the last 2 years from the perspective of selling homes, right? Well, guess what? They were able to go get a job being a manager of the restaurant or whatever. Like, there's just so many openings. So I don't think that enough people took that into account. Now, the other thing I'll say is I do believe, because the amount of job openings has come down substantially the last few years, you know what? Let me pull that up for you guys. I think that would be a good thing for me to pull up here, is the amount of job openings. Alrighty, folks, here we go. So what I'm showing you right now is the United States job openings. And so you see, like, yeah, we were up to nearly 13 million back then, right? It was over 12 million job openings back in early 2022. Incredible number. Now, at this point in time, we're down to about 8 million job openings. So the thing I would say, if this number keeps coming down and keeps coming down, I think we're going to get closer and closer to eventually setting up for a recession. Because then you talk about, if the jobs market eventually gets hit, then people won't be able to just go out there and find other jobs easily, right? And so still at this point in time, if you lose a job like this, there's other opportunities out there. So that's what makes it really hard to get that big unemployment cycle right now. But if this number keeps coming down, eventually it gets a lot easier to have that unemployment cycle, right? We back this up here. So, amount of job openings going into the GFC was under 5 million. We were under 5 million in that situation. And then obviously that went down rapidly, right? Here you're even looking like we're still, November 2007, we're still at about the same amount roughly. This is, a little under 5 million. And then we drop quick to 3 million job openings, 2 million job openings. So that's the sorts of numbers we got to think about to be really worried and concerned. If we drop this number down to 7 million, then 6 million job openings, I would start to get really concerned about the state of the economy, because that would be a situation where as soon as you get some sort of shock in the markets, some sort of shock in the economy, the credit markets, whatever, things could get ugly quickly there, because people wouldn't be able to find other opportunities if they lost their job, right? Jobs is really, as long as people have jobs, the show goes on. When people don't have jobs is when things get tough, right? Walmart beats estimates, raises outlook, and sees stable consumer health.
Earnings of 67 cents adjusted. That's higher than the 65 cents analysts expected. The discounter also...
Who's this lady? I've never seen her on CNBC, I don't think, in my life. What in the world?
Expectations for revenue with $169.34 billion. That's above estimates of $168.63 billion. The company raised its forecast for the year to reflect its strong first half, saying it now expects sales to rise by between 3.75% and 4.75%, and it expects adjusted earnings to come in between $2.35 and $2.43. I spoke to Chief Financial Officer John David Rainey, who told me that Walmart has not seen a change in shopping trends. He said every month of the quarter was relatively consistent.
John David Rainey? Don't ever trust somebody with 3 names, right?
He said, we see among our members and customers that they remain choiceful, discerning, value-seeking, focusing on things like essentials rather than discretionary items. But importantly, we don't see any additional fraying of consumer health. It also saw strength across stores, clubs, and its website, notably with U.S. e-commerce sales growing 22%. And he said Walmart saw another promising sign. Sales of general merchandise, that's the stuff that's outside of its grocery department, was positive for the first time in 11 quarters, Mike.
That's probably going to be taken...
Wow, that's interesting.
Stuff that's outside of its grocery department was positive for the first time in 11 quarters, Mike.
That's pretty shocking. First time in 11 quarters outside of grocery was positive. Interesting. That's more proof that you're coming out of the consumer goods recession, right?
That's probably going to be taken as a relief, I would think, by investors, considering that July in particular, I think folks felt was maybe a little bit soft for a lot of the industry.
Yes, John David referred to that, and he also referred to the concerning jobs report that created some concerns. And he said, we are not expecting a recession. He really kept talking about how they've seen consistent behavior, even with the start of the quarter. Yes, people are still watching their dollars, but there's no noticeable change, he said, and that's really the key takeaway here.
I don't know if you have the numbers offhand. U.S. comps or like U.S. comps ex fuel. I know some of the street was watching that.
Yes,
kind of core.
U.S. comps were up, and they were up also globally. And one thing that John David Rainey said also is that they are seeing that people are choosing them not just because of price, but also because of convenience. He pointed to that e-commerce growth. And I think one thing that some investors may have been missing is that Walmart's made a lot of strategic plays here. It's been growing its third-party marketplace, growing its advertising dollars. It's launched a new private label brand in grocery. And those types of things are also moving the needle, along with attracting people who are frustrated by inflation.
Seeing U.S. comps at 4.2%.
4.2.
Ex-fuel.
Ex-fuel, they were up 4.2?
Yes.
I think the whisper going into this was more like 3%. That would certainly explain why the shares are up 5%.
Yeah, exactly. And the other thing that was interesting that he mentioned is that they are seeing people who are just, being a little bit more willing to spend for seasonal items. And so seasons are very important. Back back to school, he said, started strong, and generally that's seen as a indicator for the holiday season. So that may be some good news too.
Really interesting. Shares are up almost
Looks like an
5%
all-time high, actually.
right now.
Yeah.
Here's the only weird thing. Walmart Jim Paulson has the Walmart recession indicator. When Walmart shares do well relative to luxury shares, that's typically a sign of a slowing economy. So you have to read it both ways. Is it good or bad that they're going up? I think they're going up today for the quote-unquote good reason.
Yeah, and it's gotten complicated with the e-commerce side of Walmart, and
because you think there's a more upscale version of,
and just the market share gains that they've had. It's a little more representative, arguably.
Certainly than 20 years ago.
Yeah.
Absolutely, I completely agree. Much broader swath of the U.S. consumer, or the kind of spending it would capture than in the past. Yeah.
Yes, that's the tricky thing to tease out. How much of this is because of Walmart's own strategic moves versus people trading down? Historically, you're right. When Walmart did well, it was almost seen as a concerning sign. You know, our even upper middle and high income consumers being forced to go to Walmart. But now Walmart's saying, hey, we're getting, you know, a little fancier, or at least, you know, even though like with Better Goods, its new private label grocery brand, most items are under $5.
Walmart's been a sneaky stock. I got to be honest. I mean, 1 year up 38%. The stock's done very, very well. It's been a sneaky stock, man. Like just one of those stocks that, you know, you don't really kind of think about like who wants to own Walmart stock, but it's a sneaky good stock. So on a 1 year up 37%, that's wild. No, this is crazy. So on a 1 year, Walmart's up 37%. On a year to date, Walmart's up 37%. That's crazy. If we take a peek at the 5 year, it's up 94% in the past 5 years. So yeah, and then down here in the 2022 crash, it actually bottomed way before tech stocks bottomed. It bottomed in June 2022, $39. So it's getting close to a double there, because that would be what, 78 would be a double, and we're at 73 from those 2022 lows. Interesting.
But it has a lot of flavors that might resemble a Trader Joe's. So it's a little bit more, you know, appealing to a wider variety of consumers.
And perhaps most importantly, especially for equity investors, going back a couple of quarters when they first started to talk about Choiceful, you know, it's such an interesting neologism, not choosy, Choiceful, but that was the beginning of a sign that stock picking in retail was really going to matter, and boy has it. So they're sticking with that theme without saying that they necessarily see any increase in softening of consumer spend overall.
I also asked him about pricing specifically and inflation, and he said it was flat this quarter. So all the growth that we're seeing Walmart report was from units rather than dollars. And
nice.
For a long period of time, obviously, that was coming from everything costing more.
Alrighty, next one up here. Next jobs report will be a needle mover, says Charles Schwab. Lizanne Saunders? Lizanne Saunders works for Charles Schwab now? What? No way.
Markets are stabilizing. She does think a 50 basis point cut in September is still justifiable. Charles Schwab Chief Investment Strategist Lizanne Saunders joins us this morning. Lizanne, great to see you. I know you heard what Steve just said about that pad in there. What does the argument for 50 sound like?
Well, first of all, it may be justifiable based on how real rates have gone up. I don't think the Fed is going to.
Am I tripping? I swear, didn't Lizanne Saunders used to work for CNBC? Am I tripping? Like I swear it wasn't that long ago she was working for CNBC, but maybe I'm mistaken. But I'm like, I thought I remember that.
To do that. And I think today's data reinforces that the Fed's bias, at least at this point, is probably 25 basis points. I think the jobs report will be the next key measure. The Fed hasn't put inflation data in the rearview mirror, but they clearly have elevated the focus on the other part of their mandate, which is the labor market. So I think that could be the next potential needle mover for expectations around Fed policy. It's probably not going to be PCE, because once you have CPI and PPI in the books, you can kind of map to what PCE is going to be, and it doesn't look like that will be an outlier. So I think the labor market will hold the key.
I'm looking at something JP Morgan wrote last night. Looking at the next jobs report, they say job gains in the range of about 160 to 200 would likely erase much of the fear invoked by the July print. Something in the low 100s, though, they say would put that risk balance back into growth and deliver a larger cut. Do those numbers make sense?
They do, but I think you have to go beyond the payroll numbers. I think the innards of the jobs report are at least as important as the headlines around payrolls. Obviously, the unemployment rate, long-term unemployment, what you see in terms of wages, hours worked, the differential between the payroll survey and the household survey, and not just the print on payrolls, but what the revisions are for the prior 2 months and any additional assessment about the benchmark revisions that are coming in the first quarter of next year. So I don't think you get anywhere near the full picture if you stop the analysis just at the payroll print.
It's interesting.
I was down on the Strip this weekend. That was, what night was that? That was Saturday night, right? Down on the Strip, we were at a few different places. We went to it was kind of like a Mexican dancing place. And then we were at, where else were we at? We were at the new country bar, what's it called? Old Red. And we were at Bellagio. We were all over the Strip. And no signs of the ultimate recession. You know what I mean? It was just jam-packed everywhere. Jam-packed. And so it's just, another one of those indicators I'm looking at, and I'm like, it's hard to feel recessionary when people are just glad to spend $20, $30 on drinks and just happy to go to Vegas and party. And I mean, the Vegas occupancy numbers have been very good. That's usually one of those telltale signs. If you're actually really facing a tough jobs market, usually, people choose not to come to Vegas because Vegas it's expensive, right? You're on the Strip, you're going to spend a lot of money on gambling, food, drinks, all that stuff, rooms, depends on where you stay, obviously, right? So the fact that it's just so jam-packed still, and it was just, this weekend wasn't even a big weekend. There was nothing even going on here in Vegas. There's always stuff going on in Vegas, but for a Vegas weekend, there was nothing going on this weekend. It was like a dead weekend, and yet it was still just so jam-packed everywhere down there. I'm like, man, we're in a weekend in August. Come on, man. But that's just the way it is.
The Global Fund Manager Survey from Bank of America shows recession risk is the number one concern of these fund managers. Given the data that we're seeing this morning, are those concerns justified?
We will get a recession at some point, but I think this cycle has been unique.
Exactly. We will. It's guaranteed we will at some point, right? But it just gets more and more ridiculous the more you have to keep pushing it out year after year after year in talking about the big unemployment recession is coming. It's just eventually it's going to happen. That's a guarantee. It's just when.
Rolling nature of it, and that's something we've been talking about and writing about for a couple of years now. You had recessions in key segments of the economy concentrated in 2022, housing and manufacturing and housing related and a lot of consumer oriented goods. You recently saw a little bit of weakness in services, but that seems to have bounced. So I still think that that's the best way to think about this economy. That said, in terms of the launch point for the hiking cycle, and historically how many quarters it takes for that to bite and help to bring on a recession. Interestingly, we're right at that point right now, 10 quarters ahead. So I don't think we're past the expiration date on things like the long and variable labs in terms of monetary policy, the weakness that we've already seen for quite some time in the leading indicators, the fact that the yield curve went from a pretty deep and long-term inversion back into positive territory. Those are historically recession triggers. You've got the SOM rule. There's a lot that's different in this cycle. That's why I think people are reticent to say, boy, it's coming, just because of the unique nature and the rolling nature of this cycle. But when corporations are telling you that they're concerned about risk, then a recession risk, and I think it's something you have to heed.
How about getting back to the market for...
The one thing I'll say is usually when companies are talking about it on conference calls and things like that, it's the worst is always usually behind you. Just from what I've seen in the past 15 years, when they're all concerned about this and that, it's already late stage to the game, essentially. And usually things are already reversing the other way. And usually if they're still positive, things are going bad when they're still positive. But anyways, now there's a new point that's out there that's been talked about. If we talk about rates are going to come down over this next year, right? The cost of capital obviously goes down for a business, but the cost of capital also goes down for the consumer, which leads into refinancing. So you could make an argument everybody that's bought a car in the last 2 years, everybody that's bought a new house in the last 2 years, you could make an argument that if rates do come down a bunch over this next year, right, that means a lot of people are going to be able to refinance their auto loans, refinance their home loans, which means lower monthly payments, which means more money in the consumer's pocket, right? It's just math. And so it's true. Like if you're talking about mortgage rates come down a bunch over this next year because the Fed keeps lowering rates, all rates come down, and auto loan rates all come down, people are going to start refinancing left and right over the next year. And when you refinance, pretty much always, your monthly payment's going to be lower. It might be lower $50 a month, might be lower $100 a month, might be lower several $100. If you got a mortgage and you refinance at a much lower rate than what you were at, like let's say, you bought your house at, I don't know, a 7.2% mortgage rate and you refinance it down to 5.2, it depends on how much the house costs, but you could be talking about hundreds of dollars of difference, if not $1,000, depending upon how expensive the house is you live in, right? Which means then you have hundreds of dollars of extra money or $1,000 or whatever the amount is, right, to go spend in the economy, which then boosts the consumer and boosts the feeling of the consumer and sentiment and those sorts of things. So, when we talk about these range of possibilities, there's a reason I talk about a range of possibilities. That's another thing I don't think people are even considering in their models or kind of how they think. And it's important. It's really important, right?
Lizanne, it's only a few.
Oh, additionally, that means credit card rates come down, which credit card rates are insane no matter what, right? But, if that comes down a few percent here and there, okay.
Ago when we saw rates break down significantly, I think it was a CPI report, I forget. And then we had that great rotation that lasted all of, a couple of weeks, where everybody was talking about small caps. Is that not sustainable? And are we back to a mega cap-led market?
The silliest thing is a stock like Honest, they don't even have debt. Right? So it's like they're not even negatively affected by what's going on with rates. Like that's wild to think about.
Well, I think there's some sustainability in the some broadening out and some money looking for opportunities down the cap spectrum. But what I think you need to do as an investor is you absolutely want to fade any of the lower quality components of what you're seeing move in an index like the Russell 2000 and lean into the higher quality. You still have about an 18 percentage point spread between the performance of the zombie companies versus the non-zombie companies within the Russell 2000, obviously in favor of the non-zombie companies. So I just think it's really dangerous to think about small caps in any kind of monolithic way. There's a huge spread up and down the quality spectrum.
100%. If I think about companies like Honest, companies like Revolve, no debt existent type companies loaded with good amounts of cash compared to how, the size of those companies, right? Also, companies that business models can go through different cycles. We've now seen Revolve go through several cycles. We've seen Honest go through several cycles now at this point in time and make it out to the other side. So there's certain quality out there in the market and then there's certain trouble spots, right? And there's a lot of trash in the Russell and there's a lot of high quality that's been treated like trash.
Like that. And there are times where moving down the quality spectrum makes sense if you've got, that's where the leverage is to a major upturn in the economy. That often happens coming out of a recession. I just don't think we're at that point in the cycle. So the opportunities may exist, but you absolutely want to stay up in quality, profitability, high interest coverage, strong balance sheet, strong free cash flow. That's the way I would approach any continued rotation.
100%, but let's be very crystal clear about this. You don't want to just invest like that right now. You want to invest like that always. Always. You've got to stick with companies that have margins that are improving over time, revenues that are improving over time, that are growing their businesses, right? That have great balance sheets. That shouldn't just be something you look at right now and you're like, oh, this is the way I want to invest right now. That should be the way you want to invest every year because those are the sorts of companies that always get it out to the other side, right? Stock prices are going to move around based upon interest rates, what the Fed's doing, right? How people view the economy or don't view the economy, right? The facts and the opinions, it's going to move all around. But at the end of the day, company fundamentals, The strongest are strong, get through the bear markets out to the other side, right? Just like the strongest investors do. You got to make it through the bear markets. You got to have fun in the bull markets, and let's talk, baby. All right, guys, appreciate you joining me as always. Thanks so much for being here. If you're looking to apply, join my private group, get access to my private stock group, wealth group, plus 1000xstocks.com. Click the pinned comment down there, fill out an application. We'll see if we can get you in there maybe this weekend or maybe next week. All right, guys, much love and have a great day.